Good afternoon and welcome to BizTech's Midday Market Watch. Our guest today is Gabriel Yap. He's the Executive Chairman of GCP Global. Gabriel, great to have you on the show again.
Thanks, Brian. Thanks for having me.
Now, before we start, let's take a quick look at how markets are performing right now. Now, overall, we have essentially a sea of green. Markets are up sharply. We have the Nikkei up 1.26%. Shanghai Composite is up 0.88%. The Hang Seng is up 2.72%. The ASX 200 is up 1.26%. And the Kospi is up 1.75%. Now, if we look over at the presidential race, which is dominating the news flow right now, you will see that Biden is at 264 electoral votes to Trump's 214. 270 electoral votes basically is needed to win. Now, in the Senate, there's an absolute dead heat, 48 Democrat, 48 Republican. And in the House, the Democrats are slightly ahead at 204 seats to 190. Now, you need a 218 seat to get a majority. So the blue wave is still on, but it's a very, very, very tight race right now. So Gabriel, how, with all this uncertainty in the market right now, I mean, the market was gyrating yesterday, how are you allocating your capital?
Well, we have always thought in investment classes, Brian, that for the sagacious investor, events like this that cause volatility, extreme volatility, not because of any untoward deterioration in company fundamentals or earnings forecasts, earnings expectations, are probably your most propitious position, the best time for you to be positioning into the stocks of your liking. Because this kind of temporary weaknesses actually put a floor base to the prices, and if these are well-run businesses that you actually are investing into, then it puts a floor base for future price appreciation.
So then, last week we talked about, and you talk about uncertainties and throwing a spanner in the works in the markets. We were all talking about Ant IPO and how, it was oversubscribed, almost $3 trillion US dollars. But then the Chinese authorities put a brake on it. Now, what does this mean for Chinese financial fintech stocks, particularly given the increased scrutiny on their risks?
It's totally unprecedented, Brian, to begin with. I think essentially the announcement henceforth for the suspension of Ant IPO has actually caused Alibaba to sell off 8.1% now. Actually, if you look at the other fintech players, that's Lufax, the ticker LU, or which operates WeChat Pay, they sold off, Lufax sold off by 9%. That is higher than what Alibaba did. And Tencent was sold off by 3%. I think the implications is that the players that actually do the fintech, which is essentially via WeChat, Alipay, as well as actually the Lufax, which operates a personal finance platform, as well as micro lending, will come under higher scrutiny. The talk in the market is that currently, for every dollar that's lent by Alibaba, 2% is set aside. Now that amount is likely to go up to 30%. If that's the case, that will frame off, the huge and sustainable and rapid growth of Ant at the credit tech level. But this does not necessarily mean that the growth of the credit tech will actually come to a standstill, because if you look at the penetration of fintech pursuant to investments, as well as actually credit lending, micro lending, small business lending, individual lending in China, that is likely to take off, because that is an area which is termed as underbanked. And that's why the big lights of the big banks like ICBC, Bank of China, are still not operative into that. And that's probably one reason why I think that the central bank and CIRC, have actually clamped down hard on Ant at this moment.
Yeah, there's also an issue of normal in the traditional lenders funneling lending through Ant, and apparently accounted for quite a sizable amount of Ant's lending. So I think the authorities, that was also another reason why the authorities wanted to curb that sort of lending within the fintech space.
Certainly so. If you look at, for example, within the scope of credit tech within the Ant IPO prospectus earnings, they have My Bank, which is actually that's a normal bank that's instituted and run by Ant. That only constitute 2% of revenue, which means that the whole 98%, operates on the platform where the Ant actually brings in the banks. The banks will then on lend to the customers that is actually done by AI or search by AI for end customers, and then Ant actually takes a transaction fee of about 2 to 4% based on that. I think that figure will obviously now come down substantially, and you would expect that My Bank, which is operated by Ant, will actually ramp up that particular figure to be in compliance with what the authorities and the regulators are looking to enforce.
So in that case, Gabriel, one of the key things that's going to happen now is there will be a repricing of in terms of valuation of the Ant IPO when it comes back and it's allowed to go ahead, because obviously the capital requirements are completely different, the margins are completely different.
Oh, certainly so. I totally agree with you. Based on last week, as we spoke, you noticed that I've highlighted that while Ant started with Alipay, and it's even synonymous with Alipay since 2004, but the main revenue earner right now, according to the IPO practice, is the credit tech, which is actually accounting for 39% of total revenue. So obviously, this biggest earner, if that growth is going to be cut, yes, there will still be positive growth, but not at the rate that it used to be. Then it could mean, therefore, that if Ant is still going ahead with its IPO, I mean, the valuation that we saw as of last week, 313 billion US dollar, would actually be adjusted accordingly.
Now, moving on closer to home to Singapore. Now, you're a big advocate of Singapore REITs. You're the REITs guru. There's an interesting development regarding the ESR Sabina REIT merger. Could you just share some salient points of that deal?
Sure, Brian. In fact, in today's newspaper, in the Singapore media, there's strong news covering the fact that the AGM is finally going ahead on the 4th of December, which means that the showdown between Black Crane plus Quas, the two fund managers that are trying to oppose the merger, will come to fruition. But
what is the opposition to the merger from these two fund managers?
It's a very clear theoretical fact, and that's where I'm coming to it. They are actually contending. That means Quas and Black Crane are saying that, look, for the merger to take place, ESR must pay a price closer to the NAV of what. Now, mind you, Prime, academically and theoretically, that's what we learn in school. If assets are actually well run, they should be priced at a premium or even at NAV. But the big problem is that between theory and being practical, and that's where we come in as GCP Global, because for the last 31 years, we've been teaching about what the market tells us. Now those are empirical evidence. And if you look at empirical evidence, it is clear in the REIT sphere, especially in Singapore, after studying 2 decades of data, that the value of a REIT is dependent on the value of its assets, plus the value of its manager, plus the supporting role of the sponsor. Now, if a REIT, like for example, Sabana, has been trading on a downtrend, in this case, it's 26% discount to the NAV based on the supposed strike price of 37.7. But in this case, that would be the determined price, not the theoretical book value price, which is 26% higher, simply because, historically, REITs in Singapore those that have not done well, that means those that have so in the last 6 years, we look at those REITs that have not performed, like OUE Commercial REIT, Soybill, Business Space REIT, including Sabana and Lippo Malls. These are REITs that are affected with lower price to book value of less than 1. Now, have they gotten better? have those discounts actually gotten wider? In fact, the answer is yes. Those discounts has not narrowed, as what the textbook is actually telling you. So the thing is that when it comes to a takeover position, or in this case, a merger, why would an acquirer like ESR willing to pay book value? You see, when in effect, for the last couple of years, that the theoretical value in the market, that's the practical value that the market, is actually paying, is at a 26% discount. So this is a very interesting issue in this respect.
Now, is that deterioration also expected across this asset class because of the COVID-19 crisis?
Oh, no, not at all, Brian. In fact, in my upcoming book, and do buy it, as well as for your investors, it's called Making Your Millions in REITs. I've collated and shown over 2 decades of S-REIT data that those REITs that are not managed well to optimize the value of the assets, as well as having the absence of a good sponsor, will suffer materially. And in this case, I've actually highlighted in my book that the REITs have not done well, like OUE, Commercial REIT, Soybean REIT, Sabana REIT. These are the kind of REITs that actually have been suffering, lower price to book value valuation over the years. In fact, that discount did not narrow. In fact, they got wider. And for example, one case study that I've highlighted in my upcoming book is Soybean Business Trust. The moment in 2016 when the price, they used to be trading at a premium to book value. Now they're trading at a discount to book value. And over the years, instead of actually bridging the price to book value, they actually have lost and they have seen the discount actually widen from 1% to 15%. And you can see that the share price, which in the long term is a voting machine, and a weighing machine, actually wins out. And needless to say, this share price has underperformed vis-a-vis the other 40 REITs in the
market. And you cover this and other stuff in your trainings. I think you're having something coming up soon, right?
Oh, yes. Every monthly, we actually have our investment classes, which we focus a lot on technology, because I managed to triple my money on technology, as well as to share with my students on a regular basis. So the next upcoming class on the 28th of November, it's great because we have 8,000 students in Asia, from Korea to Seoul to Japan to Singapore. So do join us, come to our website, GCP Global, and if you think that you'll benefit from it, do sign up then and there.
Hey, Gabriel, thanks a lot for coming on the show and giving us these insights. We've been speaking to Gabriel Yap, Executive Chairman of GCP Global, on BizTech's Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations.